South African miner Goldfields has reported a more than threefold increase in normalised earnings. For the full year 2016, the company saw headline earnings rise to $191 million. That compares to a loss of $45 million in 2015. The company says it's managed to exceed both its production and cost targets. Shareholders are due a full-year dividend payout of 110 South African cents a share in March. Well, earlier, our markets anchor Nompumelelo Siziba caught up with Goldfields CEO Nick Holland. She started by asking him how the gold price features in their performance.
The gold price went up $100 an ounce, and that did help us. But importantly, what is really nice is our operations delivered into it. And we were able to deliver on our guidance. In fact, we over-delivered on our production guidance and our cost guidance for the year. So we were able to enjoy the fruits of the higher gold price. Often you find the gold price goes up and then you don't produce the ounces into it. So I'm really proud of our teams. They've done a super job in making sure that we were able to benefit from that gold price. So I think from that perspective, a good year. Safety improved as well significantly across the group. Costs were well controlled. We've reduced our debt. So I think the team feel that 2016 has been a good year for them.
You mentioned that you overshot your cost targets. So how did you go about reducing your costs?
Well, we were also fortunate with exchange rates in various countries that we operate in. You know, the rand did weaken last year, the Australian dollar weakened. Also, we've been able to just continue to improve our productivities. In our open pits, our mining costs have gone down through efficiency improvements, productivity improvements, improving procurement practices. So there's a whole myriad of different initiatives across the group that we continue to deploy to really chip away at these costs. So I'm sure we'll see some more this year as well.
You recently made an acquisition of 50% of a gold mine project in Australia. What value are you hoping that will add to your operations?
Well, what we've done here is we've bought 50% of, it's a project that will become a mine within 2 years called Gruyere. And there's nothing cheesy about this acquisition, I can tell you. This is a quality acquisition. It's a long life operation. The reserve alone is 13 years and the costs are going to be low. We think the all-in sustaining cost of full production will be about $700 per ounce. And there's big upside after that in the resource. The resource is nearly double the reserve. And also it positions us in a very important new camp, the Yamana camp, which is in the outback. The outback is huge, I must tell you, but it's a 5,000 square kilometre position that is largely underexplored. So we're sort of slap bang in the middle of that. And I would hope that this is the beginning of a bigger relationship with our joint venture partner, Gold Road.
You also overshot your production targets, but how soon are you hoping that your South Deep mine will be adding further to your productive capacity?
Well, I think we're going to see incremental increases at South Deep over the next 5 years. We got up from 200,000 ounces in 2015 to 290,000 ounces in 16. That's a 47% increase. And over the next 5 years, we're planning to take that up to 500,000 ounces a year. So there'll be sort of incremental step changes over that period, but that will add significantly to the portfolio. And importantly, it'll bring down the unit cost quite a bit.
I see you managed to whittle down your debt quite substantially to about $1.1 billion. But with talk of interest rates happening in the US, aren't you concerned about the servicing of that debt, given the fact that obviously your service costs will rise?
Yeah, I think the likelihood is that you may find that there's 2 25 basis point hikes in 2017. That's what consensus is saying. But 50 basis points on our debt is not going to be a big increase. And you know, you're talking about interest rates at all-time lows. I mean, US LIBOR, which is the basis for determining our loan interest rates, is really down to like 1%, 1.5%. It's really, really low. So our debt service costs are already quite low. So a 50 basis point hike wouldn't be too bad for us.
Nick, are you concerned that the mining industry in general is going to become more capital intensive and move away from labour, because that seems to be the way forward these days?
Well, let me first say I think that gold and platinum have significant risk on the downside from here. So I think there is potential, particularly in gold, for gold production to continue to decline. So just the decline in gold production alone is going to be a threat to jobs. I think technology and innovation often results in fewer, more skilled people, which is the way the world is going. But obviously, when you're in a country like ours with significant unemployment, it does become a social problem. And so I think we have to find a solution as a country that says, how do we grasp innovation and technology, and how do we try and take people who might be displaced as a result and provide alternative livelihoods for them. So I think we need to have industry and government working together in finding solutions for this. But I think you can't hold back technology and innovation. It's going to drag you down the road. You can't stop it. And so I think we've got to figure out how we're going to get on this bus and steer it in the right direction, because it's better to be on the bus than not than off the bus altogether. And then you stand here and you're going to just go down.
How hopeful are you about gold, the gold industry in general? You have to compete against things like platinum and obviously equities as well. So given that, I mean, you've made all these investments, you seem to be confident, but what's informing your confidence?
Look, the gold price is affected by so many things. You know, who would have thought that after Brexit and Trump getting in, that gold isn't even higher than what it is? And yet it isn't. And there's obviously other factors affecting it. I think the positive for gold is that interest rates continue to be very low. So although you don't get a yield on gold itself, the competing investment products aren't giving much of a yield either. I think we'll continue to see uncertainties around Brexit and the so-called protectionism strategies that President Trump is going to deploy in the US. It's going to be interesting. And of course, geopolitical tensions, the demographics in Euroland with a lot of older people not contributing to the economy, but of course needing healthcare and pensions. So gold has a role to play in all of this. So I think gold will be relevant again, as it has been over the last 100 years.